If you put together a deferred compensation plan, you have to use a third-party administrator. So that's one of the things that we help you do is find the right third-party administrator. But what they'll do is they'll keep track of all the money that's gone into the plan and then what is owed to the participant based on the vesting schedules. And then they'll produce benefit statements for the participants, and then they'll do all the accounting for the employer. And when the money goes in the plan, you will build a liability on your balance sheet. So the Schwab account that we put money into offsets the liability on your balance sheet. So it's a neutral event. But the third-party administrator will keep track of that. Let's say you have a down year and you skip making a contribution. You're going to want to know whether you are lined up with the liability of what you owe the participants. Now, the fourth strategy that we use is called the Management Incentive and Retention Plan. It looks a lot like the deferred compensation plan, but in this plan, what we do is we make a commitment to put a fixed percentage of a person's salary into the plan every year if they hit the performance numbers that you want to see happen with the company year in and year out. But you make a commitment. If we perform like this, you're going to get 15% of your base pay or 20% of your base pay put into a plan that gets invested in mutual funds, that provides a long-term benefit like the deferred compensation plan, but it has death benefits associated with it that are lump sum, that are tax-free, that provide a large lump sum tax-free benefit to the family if the participant dies early. And that can be real important if you have people that have young kids at home and they know it's going to be 5 or 10 years before they really start building anything up in the plan. If they die prior to having much in the way of wealth that could go to the family, this plan, the Management Incentive and Retention Plan, provides a lump sum tax-free death benefit to the family. You know, and sometimes it's $250,000, sometimes it's $500,000, sometimes it can be $750,000. It just depends on the mix of the executive team and their salaries and how that all comes together. But the bottom line is you can provide long-term benefits and wealth building if they stay to retirement, but if they drop dead early, their family will get a lump sum tax-free benefit. So we call that the Management Incentive and Retention Plan. We'll typically use an insurance product that's an institutionally priced product. It's not a retail product. It's designed for corporations and executive teams, so it doesn't have all the big loads and fees that you'd have on a normal retail product. And it's designed to be very strong on the balance sheet. So if you move $1 out of cash and you put it into cash values of insurance, it's as close as possible so your balance sheet doesn't change. So those are kind of the four things that you can look at doing. Stock ownership, either a stock bonus or a sale under a note strategy to your executives. A phantom stock plan that looks and smells and acts like real stock, but it's not. So you keep 100% of control of what happens to your shares. They stay in the family, basically. The third thing is a deferred compensation plan, where you agree to defer a certain amount every year, and we put it in a brokerage account and we build it up. We have vesting schedules and all of that with it so that it's designed to build a big bucket of wealth for an executive, and there's some cost if they leave you early. Fourth thing is the Management Incentive and Retention Plan that not only provides wealth building, but provides tax-free lump sum benefits for your family. So that's kind of a nuts and bolts about how you would go about doing this. I can tell you, when you put a plan like this in place, the chances of somebody else poaching them and taking them away is very, very low, as long as your compensation is competitive. Now, if you're paying way under market, then that's a whole nother problem. But if you're paying market compensation, and then you add a plan like this over and above what you're paying them in salaries and bonuses, the chances of you hanging on to this team is really, really high. And when you put performance indicators in there, you're able to actually hold them accountable to performing. And those who are really good will rise to the occasion, and those who are kind of just limping along, they'll get exposed and you may not want to hang on to them anyway.